We've got one more name here, though, with a little twist. Apple. Now, remember, 2 weeks ago, the Chartmaster Carter Worth laid out a big fade on the stock.
My thinking is, this technician, that it's just too steep, uncorrected, almost unnatural. From the absolute low of June 16th, Apple's up 35%. And the angle of the line is becoming increasingly unnatural. No givebacks, not even a down 2-day sequence. And so not only do we have that sort of unnatural line, we're up against a downtrend line.
Well, that was a good call. The tech titan dropping more than 9% since then. So we have to bring Carter Worth back. Carter, we're going to ask you to play the game from here. Trading or fading Apple at this point?
Yeah, it's. I'm going to break the rules here. I think you do nothing, so I know that's not helpful. Meaning, after a 10% sell-off, really press the short? That seems a bit aggressive, but just because it's sold off 10%, buy it? Really? Why? Meaning, we've had a 10-day sell-off that's 10.8%, and yet it's just in line with the Qs. The Qs are down that much, 10.8. The Russell's down 9.2. So I think there are these moments that we try to be actionable. We all do. Try to call the direction. Then some moments where, I don't know, it's pretty close to 50-50. I guess if one has profits in this short, I'd clear out and go on the sidelines. But if I were on the sidelines right now, I don't think I'd get on this on board, long or short. Leave it alone.
Does this mean that the leave it alone option also stands for the broader markets?
Well, no, I think the broader markets in general, and then you could say there's so much autocorrelation with Apple at 7.3% that the answer is the same for Apple, that if I'm going to say the general markets are going lower, then Carter, aren't you saying that the Apple's going lower? If I have to be directional, I would rather be underweight or short Apple, and that's the same for the market.
Okay. See, I feel like that's okay if Carter breaks through because the message was clear from him, and that was do nothing. It wasn't do this first and then do that. But Jeff Mills, where would you stand on Apple here at this point?
Tim mentioned it earlier. I think almost at 20, 25 times forward. It's really never been that expensive in the 10 years prior to COVID. And for me, it all comes down to earnings expectations. Again, I mean, even if you don't see a fall in earnings expectations, you're still talking about a 23 times multiple in the out years. And you mentioned some of the guide downs, Mel, Seagate, HP in the hardware. I know it's not exactly the same, but at the same time, iPhone still has over 50% of its revenues tied to Apple has 50% of its revenues tied to iPhone. So, I think the weakness in consumer will ultimately permeate into Apple's earnings, and then that will put pressure on the stock, not to mention the fact that the multiple is where it is right now.
Carter, I understand that you have another chart that you've brought along for us. CRM?
Well, I thought we'd talk about Salesforce. I got 3 of them, actually.
Oh, okay.
But let's look. Here we go. They're all the same time frame, so it's just different lines, different ways to draw the line. So we know that Salesforce bounced with the market, but the problem is it's only 1% above its 52-week low. It would take the S&P an 8% drop to get to its 52-week low. The NASDAQ, a 10% drop. We're hovering ominously right at prior lows. Another way to draw the line, second iteration. You can see it here on your screen. Or third iteration. It's all the same chart, but we are breaking, we're hovering ominously. So relative strength is poor, price volume is bearish, correlation, and I think you're going to take out the lows. NVIDIA's in the same boat, Adobe, and that's kind of the problem with the market, because the big names in tech, among other things, are not acting well.
Guy, if you are a believer that there is some caution amongst corporate America, amongst enterprise in terms of spending, then that makes sense that Salesforce would break.
That's been, and that's been Karen Feinerman's theme. If I know you know this, I mean, that's how she's sort of been hedging some of her long positions vis-a-vis exactly that. And I'm with Carter on this one. I mean, if you recall when he put that Apple call out, I was on the phone doing hedging strategies, which was one of my best gags ever of all time. And he was spot on in his timing. And he's going to be right on this one. By definition, I think in this environment, high multiple stocks valuations have to come down, regardless of what you think of the companies. They're great companies. They're just too expensive in this environment.